Okay, welcome back. And we're going to do this next section. Each year, I do the risk management section by myself. David will not be participating in this section. Um, this happens to be the section that gets the biggest response from attendees from the Master Trader Program. Really is a very, very important section of the curriculum, and it's a bit long. We're going to go through quite a bit here. Some of it you may have heard before, and some of it I assure you is going to hit home. Um, so the first thing to remember is that these stocks are not like mutual funds. They don't manage themselves, and left unmanaged at some point, you will have a big problem. So it's all about risk management. Everything we do is all from a risk first approach. Even the selection of the stocks, we're backing into those trades based on finding low risk entry points. So risk management is everything in it. And that risk rate, the risk to reward ratio is really what's most important, is that you're maintaining that. And that's what we're going to talk about today. We're going to talk about assessing the risk and managing that risk reward relationship and really understanding risk, really having a real great understanding of risk and the pitfalls and the math behind it. I tell this story quite a bit, and maybe you've heard it before, but it's always important to go over it again. I think it's very powerful. It's also a very powerful exercise that you can conduct yourself on your own trading, specifically or particularly if you're experiencing the type of trading that I experienced back when I first started in the 1980s. I started my very first trade was in, I believe, March or April or May of 1983. And for the first couple of years, I really had no strategy whatsoever. I didn't know anything about anything. I was doing everything exactly the opposite of what I do today. But then over time, I started learning and studying and reading, and I was warming up to the idea of cutting my losses. But problem was is that I didn't my discipline wasn't resolute. I wasn't where I was being disciplined all the time. I would actually stay disciplined for quite a while, and I would cut my losses. And then every once in a while, I would fall in love with a stock, or the stock would blow through my stop, and I wouldn't want to take the loss. So I'd wait for it to come back, and then it would get worse. And before you know it, I'm taking, the occasional 20, 30, 35% loss, and in some cases, even bigger. And so what happened was I started thinking about this, and I said, this loss cutting, I really like to know if it really does work or not. And I took a look at my performance, and it was pretty crappy. I was down 12 or 13% after a bunch of trading, and I was making no progress. So I said, let me just go back and just arbitrarily just cut my loss at 10%. Just put a line in the sand at 10%, and then take a look at what would have happened if I steadfastly stayed with loss cutting at 10%. And then what I did was I also adjusted the losses that were smaller, larger to 10%. So every loss was 10%. So even if I had, cut a loss at 5%, I actually made that a 10% loss. And if I cut a loss at 30%, I made that a 10% loss. So this particular chart here is not the exact trades, or aren't the exact trades that I did, but it's very close to the results with the numbers here. It's a hypothetical example, but I was about 50-50. My my wins and my losses were about 50-50, and my average gain was pretty good, but my average loss was very close to my average gain prior to doing this exercise. So then I took all those losses and I adjusted them all to 10%, and I recalculated what my return would be. And I came back, I was up almost 80%. So the first thing I thought was, well, I must have done something wrong. I must have calculated it wrong, because there's no way we go from a 10 or 15% loss to an 80% gain, this 90% swing, just from this one little adjustment. So I did it again. I ran the numbers. I went over everything very carefully with a fine tooth comb, and the number came back exactly the same. I ran it a third time and it came back exactly the same again, until finally I realized, that the numbers are actually right. So in this example here, you can see what's really important to look at here is look at the average gain and the average loss. Now, these trades right here, if you were to run these trades, it would come out with a 12.05% loss after these 20 trades. Now, if you adjusted these losses, which you see some are 7, 8%, 10%, and then you got a handful, nothing really huge, but 30, 25, 20. If we adjust those all to 10%, the return moves up to almost 80%, just like in my own account. But here's I think the real eye-opening thing. Take a look at the average loss. It's 15.9%, right? In this example. And the adjustment now is 10%. That's only a 5.9% adjustment. Nothing has changed. The batting average is exactly the same. The average gain is exactly the same. And the loss just got taken up by about 1/3, from 15.9 to 10. And look at what happened. Just amazing. And that's because losses really work incredibly against you. Now, if you happen to have, if you want to try this in your own account, if you're cutting your losses well, then that's not the problem. If you're not, you might be very surprised if you do this example. Now, there's 3 key things that you need to know about losses. The first one is that you're going to have them, and you're going to have lots of them. If you trade for any length of time, you're going to have lots and lots of losses, and either you manage them or they're going to manage you, and they're not going to manage you very well. I can tell you that. So you're not going to be correct all the time. You're definitely going to have losses. So that's the first key fact about losses. Number 2 is that losses work geometrically against you. What that simply means is that the bigger the loss, the harder it is to recoup. And some of you have already, you know this chart of looking at what it takes to break even from a loss. So when we talk about an 8% loss being a maximum stop, there's a reason for that. It's not just a number that's pulled out of a hat. One reason is because, just based on charting and fluctuation of individual stocks, that's enough room to get it right, to get your timing right. That's just something that, we've looked at going all the way back to the late 1800s even, and nothing has changed. That's a decent amount of room to give a stock if your timing is correct and you're doing things the way that I prescribe. But the other reason, and the really important reason, is that the math, when you get past that, once you get past 5, 7, 8%, the math starts to work against you. So for instance, a 5% loss takes a 5.26% gain to get even. Pretty much apples to apples. You're only losing 0.25%, right? But now a 10% loss takes an 11. So now you're losing 1%. It's not as easy as just losing 10 and then going back up 10%. You got to go up 11%. But look how the math really starts to work against you as you get to 20 and 30 and 50. And oh boy, I hope you don't have any 90% losses, but I'm sure some of you have had those type of losses. And that's a 900% gain it takes to break even. So even if you let a stock drop 50%, it has to double to get back to break even. You have a stock at 100, you let it go down to 50. Now from 50 to 100 has to double. Or even if you buy another stock, you're going to have to go and double your money now, because you cut your money in half. So the third key is that the only protection that you have against a large loss is to take a small loss. There is no other way. And every large loss starts as a small loss. So keeping losses small is the only protection that you have, just like an insurance policy. You're taking that small, paying that small premium versus, say, the value of your home to protect yourself in case of a major disaster, in case of a loss that you won't be able to recover from. So that's the whole concept behind cutting your losses. It's an insurance policy. It's very simple, that you're just, taking a small loss to avoid a large loss. So now, when we think about risk, and we think about risk versus reward, there's something called R's, which is just simply the ratio of your upside to your downside. So if you were to risk 20% and then sell your stock at 20%, that would be a 1R trade. You would that's equal. 20 and 20 is equal. However, if you were to risk 5% to make 20%, now that would be 20 is four times 5, right? So that would be a 4R trade. So not all losses are created equal, and not all gains are created equal. All right. The trader that goes in there and risks 10, 15, 20% to make 10, 15, or 20% is operating at a 1-to-1. They're basically not getting any odds on their money. If they're operating, if you were to take larger losses than your gains, then you're actually laying odds, and you're giving odds, as opposed to getting odds. If you were taking 5% risk for 20% gains, then you would be getting odds on your money. So basically, this is how it just looks in real life. You go in there, you buy a stock, you try to time that stock. We're trying to time the stock at the right moment. Hopefully, you get it right, and you don't get stopped out, but you're going to get stopped out probably 50% of the time over time. Now, if that stock runs up 50%, you made 10 times the risk. That's a 10R. But now you might think, well, I bought this stock, and it was a great company. I bought Amazon. I held it down 30%, and then it went back up, and I made 30%. What's wrong with that? Well, everything's wrong with that, because you're not getting any odds on your money, and it may have worked. And you may say, well, I'm going to buy quality. These stocks always come back. That's actually not true. They don't always come back. As a matter of fact, we talked about the 50-80 rule, but just want to point it out once again. Once a secular leader tops, when you get one of these big leaders that has a big move, and it's deemed the true growth stock, the safe institutional favorite, when those stocks top, they'll go down between 50 and 80%. As a matter of fact, 50% of them will go down 80%, and 80% will go down 50%. And many of them don't come back, even if they're quality names. Sometimes they don't come back for minimum 5 years, sometimes 10, 15, 20 years, sometimes even longer. As I pointed out before, Xerox and Eastman Kodak, back in they were the darlings of the 1970s. When they finally topped, they took 24 years to get back to break even. Even recently, you had Cisco and all these other companies, Microsoft. Microsoft is at new highs now, but it took 20 years for Microsoft to get back to break even. If you were buying it in late 99 and refused to cut your loss and just hung in there with the quality company. So the real key is to think about, and this is the way that I like to put it, and I think this really puts it into perspective. So here's a little exercise, or a little example that I like to do to put things into perspective about how you should think about losses, or think about one-time events. So two people are looking to cross a road, or two people cross a road. The first person looks both ways very carefully, and then runs across the road and gets hit by a car. The second person covers their eyes, cover their ears. They can't see anything. They can't hear anything. They run right into a whole bunch of traffic, and they make it to the other side safely. So now the question is, if I were to tell you that I want you to bet on which one is going to make it under that scenario. So the person, one person's going to look very carefully and then go across the street, eyes wide open, and try to make it to the other side. The other person's going to close their eyes and close their ears and run right into heavy traffic. You'd probably bet on the person looking carefully. But how about if I told you that the outcome that you're betting on was over 100 times that it happened? So now they each do that 100 times. Who do you think would have the higher percentage of making it to the other side? I mean, at any one time, yes, the guy covering his eyes might make it safely to the other side. But would you bet on that? Would you bet on that happening over time? Of course not, right? There's no possible way that you would ever bet on the guy covering his eyes because he just got lucky that time, right? So again, think about your trades. You're not going to just make one trade. You're going to make hundreds at least, if not thousands or even tens of thousands if you're in this business as long as I've been in it, or as long as David Ryan, or anybody that's has this as a career or even as a hobby. You're going to make lots of trades over time. So it has to be repeatable. It has to be something that you can do over and over and over and that you can count on. So the first rule with dealing with risk, the first rule of investing or trading in the stock market is to always get odds on your money. Always get odds on your money. So take a look at this chart here. So at the bottom, the ratios are you're getting odds, right? At the top, you're laying odds. So let's take a look at what happens here. So if you're laying 2-to-1, so that would mean that your risk is 10%, your gain is 5%, right? You're gaining half of what you risk. Just to break even, you've got to be right 67% of the time. If you're laying 3-to-1, you got to be right 75% of the time. But now let's go the other way. Let's say now you're getting odds. So you're getting 2-to-1 on your money. So you maybe 10% on your gainers, you're losing 5% on your losers. So now you can be wrong 2/3 of the time. You only have to be right 33% of the time, and you're still not losing any money. You're not getting into any trouble. And if you happen to have a 3-to-1, you could be right. You could be wrong 75% of the time. If 5-to-1, 17% of the time, you could be wrong 83% of the time and still not get yourself into any trouble. So as you expand this risk reward ratio, you build in, it's what I call building in failure. You build in a lot of failure. You're able to make mistakes. You're able to be wrong a lot of times and not get into trouble. But if you go the other way around and your losses are relatively large, now it's just the opposite. You've got to be perfect. You've got to be right so often, and it's very hard. It's very hard to be right a lot in the stock market. You're gonna have a lot of times where you just make mistakes, where the market isn't right. So we want to build that into the system, and that's what I've done. I've made it where my whole trading approach is all around keeping the risk reward ratio intact, to always keeping that reward to risk ratio a positive number, always having what they would call an edge. The other thing too is you have to realize that the only control, you don't control how many times the stock goes up versus goes down, what your profitability is, and what percentage of time, what we call the batting average. You don't control those things. You don't control how much you make on a gaining stock. You don't control how much the stock goes up. So you only have direct control over certain things. One is what you buy. The other one is when you buy it, how much you buy, position sizing, and when you sell it, profit taking and loss cutting. So these things are the things that you have total control over. You have no control how much the stock goes up, profitability, and you have no control over the frequency that it happens. So your batting average. So the question is, how do we get control? because that's the whole idea. The whole idea is to mitigate risk and to get a degree of control over our trading and to make it so this isn't, a lucky shot here. We don't want to, when you're going into a business, you wouldn't go into a business that it was just happened to be luck if you had customers one day or if you were successful. You're going to have a strategy, advertising, and certain products. So this is what we want to do with trading, right? Trading is a business. All right, this is, if you want to treat this like a hobby, it's going to pay you like a hobby. If you want to treat it like a business, it'll pay you like a business. If you're a good businessman and you really know what you're doing and you stick to the rules, you'll get paid well. So the way that we get control over the things that we have no control over is to not rely upon them. Is to relinquish our reliance on them and to use the things that we do have control to offset those things that we don't have control. Let me show you what I mean by this. So I said the words building in failure before, right? So what does that exactly mean? I'm going to show you an example. And again, we've looked at numbers. I mean, I've been doing this now for almost 40 years. And when I tell you I have quantified, virtually everything that you could think of with stock trading, just between, anecdotal experience for almost 4 decades and running my computers for decades and decades and decades. And we looked at so many scenarios and really have just boiled it down to what works, the shortest distance between 2 points, what we can have the most control over, and also what really protects us on the downside. And what we found was that if you have your edge is built on a batting average, if a high batting average is your edge, if you lose that edge, you have a higher chance of having a big problem or blowing up. Your risk of ruin is much greater than if your edge is built on risk reward. Because again, like I just said before, if you have the right risk reward ratio, you could actually have a low batting average and still not get into any trouble. So let me just show you. This is something that I always like to show this example, and it really is an eye opener. So there's 2 traders, right? We're going to call them trader A, trader B. The first trader is basically a 2-to-1 trader. In this particular example, this trader's got an average gain of 15%, an average loss of 5%, which is 3-to-1. However, the batting average is only 40%. So when you adjust it for the batting average, your adjusted win-loss ratio is 2-to-1. This trader would be a 2-to-1 trader. So after 10 trades, with under this scenario, 10 trades meaning 4 trades were winners, 6 trades were losers. The average gain was 15% for the 4 winners. The average loss was 5% for the 6 losers. This trader would return 28%, right? 28% return on investment. Trader B now. Trader B has an inverse risk reward where the risk is actually higher than the reward. So average gain is 7.5%. Average loss is 15%. That would be a 0.5 reward to risk ratio, right? Or 2 times the risk as the reward. However, the batting average is 80%. This trader is right 8 out of 10 times. So there's 8 winners at 7.5%, and there's only 2 losers at 15%. So this is someone who would hold their losses longer and let losses get larger, obviously. So again, when you adjust this for batting average, this trader's a 2-to-1 trader, just the same as trader A, and 10 trades would yield 28%. So you say, well, what's the difference, right? I mean, either way you're getting there. There's more than one way to skin a cat as long as you get that 2-to-1, right? Well, not exactly, because now let's say trader A starts losing their edge. Their edge is built on the risk-reward relationship, right? And trader B, their edge is built on the batting average. That's their edge. So now let's cut in half trader A's edge. We're going to just trim off half of the gain. So we go from a 15% gain down to a 7.5% gain, right? So now that ratio went from 2-to-1 to 1.5-to-1. So now the trader B, what we're going to do is we're going to cut down that batting average from 8, we're going to leave the risk reward alone. Still 7.5%, 15% losses, but we're going to cut the edge in half and chop that batting average in half. Now they're only right 40% of the time. So now let's take a look after 10 trades. So 10 trades yields a loss of 2%, essentially break even for trader A. Trader B loses almost 60%. Now, you might be thinking, that's not very fair. Okay. That's, cutting that batting average down. Maybe that trader wouldn't have such a big loss of that edge. Okay. So let's do this. Let's penalize trader A even more. So we're going to do the same thing. We're going to cut the average gain in half to 7.5% from 15 to 7.5. But we're also going to cut off 1/4 of the batting average edge. So we're going to go from 40% now to 30%. So now trader A is only right 3 out of 10 times. Right? We've cut down two parts of that trader's edge. Trader B, we're going to be more forgiving. We're going to be less critical and cut less of their edge and only take just 1/4 of their edge. So it went from 80% batting average. We're going to just knock it down to 60%. Okay, take a look again. 10 trades. Trader A loses 13%. Trader B loses 20%. Significantly, that's just in 10 trades, of course. Significantly more, right? Okay, let's look at it even further. So now we're gonna actually be a little bit even more forgiving on trader B, because we're going to raise the average gain. We're going to say, okay, so now we'll just have them keep the same batting average, the same 40% batting average. They lost their edge by half, just like trader A. But trader A, we're going to still lose the half of the edge and lose 1/4 of the batting average edge. And on trader B, we're going to cut the edge in half, but we're going to raise the average gain by 2 times. We're going to bring it from 7.5 to 15. So now they're making just as much as they're losing. 15% on the upside, 15% on the downside, and right 40% of the time. So you would think, that's not too far below 50-50, right? So 15 and 15, how bad can it get? Well, let's take a look at the results. So trader A loses 13% after 10 trades. Trader B loses 42%. And the gains are equal to the losses. You see, that batting average edge is really important, because that's rolling over that edge. And this is where you can run these numbers in all different permutations. There's not many scenarios where trader B is going to do better than trader A, or if any, if you start taking the edge away and you start taking that batting average away, even if you improve the risk reward relationship. So the key is that, or my goal is that I don't want to rely upon having to be right a lot. See, I want just the opposite. I've made this statement before, and people are like, why would you ever want to do that? I said, I would rather have a strategy that I'm profitable at just 2 or 3 times out of every 10 trades, versus then if I had to be 80% profitable, I'd rather run a strategy that I'm only right 2 out of 10 times and I break even, than if I have to be 80% profitable and have an 80% batting average. The reason is because how bad can it get? I could throw darts at a dartboard and probably pick 2 out of 10 stocks. So I've already taken it down to where I've built in all the failure. You can't fail much more on the batting average side. So, but if you have to be right 80% of the time, there's so much downside. There's so much room for error. But I've taken all that error out, because now what I'm doing is I'm controlling the whole equation with the things that I do control. And that is moving that loss by adjusting that loss based on where my gains are. Now I can maintain that ratio that I want, and I can still be profitable even at a low batting average. So I hope that makes sense. Now, this leads to the holy grail of trading. Certainly my holy grail. But the holy grail of trading is a simple formula. Average gain times percentage of winning trades divided by average loss times percentage of losing trades. That gives you your adjusted win-loss ratio. That's going to give you your net win-loss ratio. So very simply, if you had 10% gains and you were right 50% of the time, and you had 5% losses, obviously that would be 2-1, right? You take 10, divide it into 5, it's 2-1. So just like if you were flipping a coin and you were getting $1 every time it lands on, or let's say, or $2 every time it lands on heads, and you're losing $1 every time it lands on tails, you want to flip that coin over and over and over and over, because over time, it's going to be 50-50, and you're going to make double on the 50% that you're winning, and you're losing on the 50% that you're losing on. So you're going to make money. The more you flip that coin, the more money you're going to make. So turnover becomes good. See, turnover is great if you have an edge. If you don't have an edge, turnover is horrible. People are afraid of turnover. Turnover is wonderful if you have an edge. You want to turn it over as many times as possible. This is the law of business. If you ran a business and you sold whatever, I mean, it could be bubble gums, and you bought them for 2 cents and you sold them for 6 cents. Well, what's your goal? Your goal is to sell as many as you can. Turnover, right? Because each time you sell the bubble gum for 6 cents that you paid 2 cents for, you make 4 cents. So it's a simple equation of, now, how many times can you do it? That's trading. How many times can you roll the edge over in a given amount of time? And that tells you how much you're going to make at the end of that period. So the key is to always remember is that losses are a function of expected gain. This is a key point, that when you're setting your loss, it needs to be a function of where your gain is. So for instance, if you're making 4% on average on your gainers, well, then you obviously can't take an 8% loss. Not on average, because now your reward to risk ratio is inverted, right? You're laying odds. So losses have to be thought of in relation to gains. They're always thought of in relation to gains. Now, this gets into what I call the trading triangle. There's some stats that you need to keep track of, and this is really, really important stuff. What we find is that each year when we do this live, I ask for a show of hands. The question that I ask is, how many people right now know their average gain, their average loss, and the percentage of winning trades? And can I see a show of hands? That's what I ask for. So usually it's been as low as 5%, I think, at times. Lately, it's been better in the last several years, but it's still maybe 20%, 25% of the room. And you can ask yourself, do you know right now your average gain, your average loss, your batting average? If your answer is yes, well, then let's go a little further. Do you know the average days that your winners are held? Do you know the average amount of days that your losers are held? Do you know your largest gain in each month? Your largest loss in each month? So these are numbers that you need to get in touch with. And this is part of post analysis. We're going to talk about post analysis in a little while, but this is also part of post analysis, because we're going to use this information. This is very valuable information, and this is where you're going to learn. You're going to learn how to set your stops and manage your risk in relation to your gain, and also it's going to tell you what you're doing with your trading if maybe you're not holding the stocks long enough, or you're not giving them enough room on the upside. If you have some very small gain, well, then, you have another problem, right? You're not getting enough on the upside. See, the key is to always ask, is the reward paying for the risk, right? If you're taking 4% risk, then you need 8% profit, right? If you want to be 2-1, if you want to be 3-1, then you need 12% profit. So is the reward paying for the risk is the thing that I'm always trying to gauge. So if let's just say the market isn't very good and stocks are breaking out of bases, but normally they go up X%, but now they're going up half of that. I see that, you're not getting much gain on the upside. So now the adjustment that needs to be made is that loss that was based on a bigger number in a better market now needs to be adjusted, right? Because now we're getting less upside. So now we're going to adjust that downside. So, and we have our own software with the Mינארווני, the MPA platform. We have some software that you could put all your numbers in. As a matter of fact, we just added something that's pretty neat. And this is something you can do yourself. You don't need my software. You don't need, Mינארווני private access, but you can do this in an Excel spreadsheet. You can keep all your numbers and track them, convert your trades over and put them into a spreadsheet. But another thing that we just added was, and you can do this too, we put where you can code each trade and say, okay, this was a power play. This one was a coupled handle. This was a low cheat. This was a cheat. And then you can run these numbers for the various different patterns or whatever you code it. If you want to, maybe you have different strategies. So you code one strategy, my short-term strategy, my long-term strategy, intermediate term, options, whatever you want to do, however you code it. Then you can go and you can run all the numbers and see the numbers so that it's not everything jumbled together. And also you can see maybe there's way different probabilities for power plays or different, different numbers for the power plays than there are from your low cheats. So the main thing though is that you definitely want to have a handle on your overall numbers, the trading triangle, average gain, average loss, batting average, and you also want to know your average days held, your average days held for losses, and your largest gain, largest loss. Now let me explain to you average days held. If your average, just like the win-loss ratio, your average days held versus your average days held losses, gainers versus losers, also should be a ratio, should be a positive ratio. So if you take a look and you say, in this particular scenario, you can hear 26 days held gainers, right? On average, sold the losers in 11 days. So what that shows is that this trader is holding the winners and cutting the losers, right? Letting your winners ride. So this is what I call the stubborn trader indicator. So if you see that this is inverted, let's say it was 30 days holding your losses and 6 days holding your gains. What does that tell you? That tells you that you're stubbornly holding on to losses and you're taking gains very quick and you're not giving them much time to come to fruition. So that's exactly the opposite of what you want to see. Now, another thing I do is I look at the largest gain in any 1 month. And then I look at a 6 and a 12-month average of that. So for instance, here we look at the average gain over this 12 months of trading. It's 18.43%, right? The average loss is 8.37. So that's a nice ratio. I'd like to see that at least 2 to 1 also. See, again, in any 1 month, you can certainly have a larger loss than your gain. You might get torpedoed on an earnings report or something. But over time, if you're managing the risk and you're letting the reward come to fruition, then this number should also be a positive number. This is sort of like looking at your instrument panel. Think of it as like flying a plane, right? So you have all these instruments and you look at your instrument panel and the altitude's not right. And your horizon's off. And, I'm not a pilot, but as you can see, for those of you that are pilots, but you look at those gauges, they're going to tell you if you're flying right and if you're flying the right speed to get lift. If you're upside down, well, that's a big problem, right? So this is going to tell you if you're flying the plane upside down or right side up. This is going to let you know how well you're flying the plane. And just like instruments in a plane, there's more than just one reading. It's not based on just one thing. You want all of these to be correct. There shouldn't be any holes in this whatsoever. Your largest gain to largest loss over 6 months, 12 months should be a positive ratio. Your days held over 6 months, 12 months should be a positive ratio. Your average gain versus your average loss should be a positive ratio. And when you adjust it for batting average, should be a positive ratio. All those should be positive. If any of them are negative, then you have a problem in your trading. And now you know what to look for. You go in, you do your post analysis, and the math is going to make its way into your post analysis, and it's going to make its way into your trading. You see, again, if you look here and you see, well, I'm averaging, 6% on my gainers. Well, now, how are you going to take an 8% loss if you're averaging 6%? Something's got to change there, right? Well, can you control the upside? No. I mean, you can control it by maybe holding them longer, better selection, but that's not in your direct control right now. Managing risk has to be done in real time. All right. So until that improves, a change has to be made. So now you tighten your stop, you back into tighter trades, and you keep that ratio intact, right? Now, all this is going to distribute. This is another something else that we have in our own software, and you can do this in. I think this actually came from Excel originally. You can do this in Excel. You take all your trades, and they're going to distribute on a bell curve. Okay, they're going to distribute on a bell curve, and what you're trying to do is skew the curve to the right. That's the whole idea. Is you want the outliers to go to the right, and you want to try to build a wall on the left side. And that wall, for me, is at 8%. All right, 10% on staggered stops, but 8% is the wall for me, because the math starts working against me. Once, like I said, once you get to that 10%, now it's 11% to break even. You get much above that. Now you're gonna have some trades. You're gonna go through that, and they're gonna have some outliers on the left side of your bell curve, but there should be very few. And on the upside, by letting your gainers come to fruition using backstops and riding your winners, that means that you're going to have more on the right side, and now you're going to have a skewed bell curve, and that's exactly what you're trying to accomplish. If your bell curve is skewed to the left, well, that you're a losing trader. If it's skewed to the right, you're a winning trader. If it equally distributes, you're a break-even trader minus commission. You might be a losing trader. So you're trying to skew that bell curve to the right. Now, again, this is where what's so important about this, when you get in touch with these numbers, is that when you're in the middle of a trade, you start to think about your bell curve, about your numbers, about your ratios, and you say to yourself, "Oh, I'm at a loss here. I'm at 5%, and it's approaching 6%." And immediately you start thinking, okay, well, what's my average gain? Okay, well, I can't take a much larger loss because my average gain doesn't support this. The reward doesn't pay for this risk. And then let's say, that stock starts approaching that maximum number. Now you think to yourself, boy, if I let this go any further, I got to look at that thing sticking up on my bell curve, right? If you're being honest with yourself and you're doing the work and putting the numbers in here, you're going to see it. You're going to have that outlier. So you're going to be aware of that. You're creating an outlier, and you don't want outliers on the left. You want outliers on the right. And the same thing on the upside. When the stock moves up and you start getting above your average gain, you're moving to the right now. That's good. And now you can say, okay, well, this is actually above my average gain. If I backstop this and I get stopped out here at this gain, I actually improve my curve. My curve moves to the right. Right? And that's what you're trying to do. All that would never happen if you don't understand and know your numbers and you're not in touch with them intimately. Then they will make their way into your trading. So we also have a calculator. We call it a result-based assumption forecast calculator. And this is something where you can go in and you can mess with the numbers. And again, you can do this in an Excel spreadsheet where you can put in, what you want to accomplish, and then put in the numbers and find out what it's going to take to get there. In this particular instance, portfolio size is 200 grand. I got 25% positions. My desired return is to double the money, 100%, right? Average gain is 12%. Average loss is 6%. Percentage of winning trades, 50%. Well, you come down here, that's going to take 134 trades to get to 100%. So now the question is, how long is it going to take you to do 134 trades? If you can do 134 trades in 6 months, well, then you'll make 100% in 6 months. If you can do it in 3 months, it'll be in 3 months. Just a matter of how long it takes you to make those 134 trades. So we're always trying to get in touch with, these numbers and sort of know where we need to be and where we are, and then bridge the gap in between the two. So again, if I see this number and it was 2,000 trades I needed, I would know that I'm probably not going to be able to do that, in a year. So I won't be able to That's not going to be my annual return. That's not a realistic goal, right? So I start looking at the numbers and know, where can I adjust this, make those adjustments and see how it affects that. Now, here's the key to using, and everything that I'm talking about here is to come up with an assumption. You see, we're dealing with imperfect information, if you will. We're dealing with probabilities here. We're not dealing with certainty. We're dealing with uncertainty. So we're trying to create as much certainty as possible. But just because you've gotten X percentage doesn't mean that you're going to continue getting that. But that's why you want to have rules and a set of parameters where you know what to expect under certain conditions, and you start to get where you've got reliability. You've got some reliability on what you're producing on the upside, and then the downside becomes a mathematical equation. But here's the key. There's two types of assumptions you can make. One I call a theoretical based assumption. So a theoretical based assumption is when you say to yourself, well, this stock is 20% deep base. It's breaking out from, I don't know, the neckline, and, swing tells you that, it can go up 20%. So that's your guesstimate. And you say, okay, for 2 to 1, I can, stop myself out at 10%. I got a 20% upside. No, you don't have a 20% upside, because that's first of all, that's pure guesswork. All right. There's nothing that says that indeed is going to happen or has happened. And even if it has happened, and there's a good chance of it, it doesn't boil in your own emotions, your own idiosyncrasies, your own foibles, your own circumventing the strategy. So you might not be able to allow the stock to come to fruition, to get to that 20% gain. So what would be a more accurate number that we can calculate that would take into account not only all that other stuff, the technical analysis, everything you're doing, your strategy, but really boil down to a net of emotions, everything, results. That's what we call a result-based assumption. So what I do is I try to always keep tabs on my average gain. And by knowing that number, I adjust the loss. I adjust the loss in relation to that, to keep myself at a minimum of 2 to 1 reward risk. So if I'm averaging 10%, even though I think the stock can go up 20%, I'm not going to take a 10% stop, because I'm only averaging 10% on my gainers. So that's not going to be profitable. If down the road I improve my trading and I get to a 20% profit, well, I maybe can extend those. But then even with that point, I'm not going to want to go much more than 8%, because again, the math starts working against you. So what happens? I go from a 2 to 1 to maybe a 3 to 1 reward to risk ratio. So now it improves even better. There comes a point where I'm not going to take much bigger of a loss, and now my numbers are improving. So let me show you another example of how these ratios, how math is so powerful. And if you don't understand it and understand how to use it in your trading, you're really missing out, and it can really mislead you. All right. I want to show you something that, and of course, some of you, you've come to the Master Trader program before. Some of you have heard me speak many times, and you might know the answer to a lot of this. But there's many of you that have never seen this stuff. And it's powerful, really powerful stuff. So we're talking about these ratios, right? 2 to 1 ratio. Here, what we have right here are examples of 2 to 1 scenarios. They're all 2 to 1 scenarios. So if you take a look, 4% profit, 2% loss. That's a 2 to 1, right? 4 over 2. 8% profit, 4% loss. Still a 2 to 1. All the way up to 80% profit, 40% loss. These are all 2 to 1 scenarios. In each of these scenarios, basically what we're doing is we're having 10 trades. 6 of them are losers, 4 of them are winners, and the profits are 2 times the losers. So we have 4 to 2, right? So we have 4% gainers, 6 2% losers. You take 10 trades, you compound those, you make 3.63% on your money, return on investment. Okay, let's move it up to 8% and 4, right? We move the ratios up. Now we're at 6.49. All right, we move them up again. Same scenario. 4 winners, 6 losers. Winners are 12% profits, losers are 6%. Bigger numbers, but still 2 to 1. Everything's the same. 8.5. So now we move up to 20. Okay, now as you can see this progression, right? You can see it's getting better and better as the numbers get bigger. Obviously, it gets better, right? So what would you think the next one would be? 42 to 21 or 80 to 40? Would they be larger? Would they be better numbers? Okay, so let's take a look. So actually, once you start moving up over a certain level, you actually start going down. You reach an optimal level, and then from there, your return starts getting less until you start going into negative expectancy. So take a look here. When you go, and I'm just going to show you this chart right here. So at a 40% batting average, right? When I have a 30, we're going to look at a 40. You can look at the various batting averages. At a 40% batting average, at 20% gains, 10% losses, right? That would be 6 losses at 10%, 4 winners at 20. You're going to make 10.2% for every 10 trades you do, compounding. Now, if you move up to 30 and 15, you're only going to make 7.71%. Go up a little bit further. Let's move up to 48-24. Same thing, 48% on 4 winners, 24% on 6 losers, 2 to 1, 40% batting average. Well, now you lose 7.5%. And as you go even higher and higher until you go all the way up to 100%, 50%, you're losing 75% of your money in 10 trades. How could this be? Why all of a sudden does it go from positive and it's getting better and better and better to negative? Because losses work geometrically against you. See, there's an optimal ratio. Once you fall below 50%, you now have where you'll hit negative expectancy as you go higher on the ratio because the losses work geometrically against you and they have a larger impact than the gains. So, and all of us are going to at some point fall below 50%. Every one of us will have a batting average below 50% and sometimes for an extended period of time. So it's not as simple as saying, well, okay, I'm going to widen the loss to make up and the gainers, even if they were the same in ratio and you took the loss down, even if the upside went up in proportion, you'd be losing money. So it's not as simple as just apples to apples. Not all ratios are created equal. Now I want to show you another example. All right. And again, the more that your batting average falls below 50%, the quicker you're going to hit negative expectancy. So this is all going to shift to the left. So where you can see that the 30% batting average, you're at negative expectancy under every scenario. It just gets worse. It starts off bad and gets worse and worse and worse and worse, right? So as the batting average goes down, the whole curve shifts to the left. Now, let's take a look at another scenario. And the real key to this is there's really no scenario where you want risk to outweigh reward. All right. In this scenario, we're looking at annual returns. All right. And what my question is where would you pick your optimal? If I were to say you can have 3 years up 10% and 2 of them are positive, 1 of them is negative. So basically you have a 66% batting average over a 3-year period based on annual returns. So it would be 10, 10, 10. You make 10%, and it doesn't matter the order. This is compounding. So you can do these in any order. The same number you'll arrive at the same number. So in year 1, you're up 10%. Year 2, you're up 10%. Year 3, you're down 10%. Okay. Or 30, 30, 30, all the way up to 90. Which scenario is the best scenario? So there is an optimal number. The optimal number is 30, 30, 30. You're going to make more money At 30, 30, 30, then you're going to make at 10, 10, 10 or 90, 90, 90. Anything above 30, 30, 30 is going to make less money. Anything below 30, 30 is going to make less money. But take a look at the result. There is the bottom line is there's no good scenario. Even 30, 30, 30, which is the best scenario, and you're getting 2 winning years for every losing year, the best that you do is an 18.3% return. That's 5.8% a year. Compounded, it's 18.3. That's not even worth trading stocks. You might as well be in bonds or something, or go put your money in real estate, right? Who wants to trade stocks for 5.8% a year? That's the best case scenario. You see, and why is that? How could you have 2 years at 30%, 60% winning total, and 30%, right? Why is that? Because losses work geometrically against you. So even if they're equal and you're right, see the batting average is high now? See, the batting average doesn't help much. That's the problem. You have to have a super high batting average if your losses are equal to your gains. So no matter how you slice or dice this, the bottom line is you got to manage your risk in relation to your reward, and your risk has got to be less than your reward. You always have to get odds on your money. I'm just circling back right to where I started. Always get odds on your money. That's the rule. All right. So what does all this mean? Well, it means that what I just said, where you do have to always get odds on your money, but it goes even further than that. Let's say you get into a difficult period, right? And you get into some whipsaw period where you're getting stopped out a lot. Some people use ATR, which is the worst thing you can ever do with stock trading, is start relying on ATR, because ATR will widen the stop based on the volatility. You want to do the exact opposite. When you start getting into a period that's difficult or volatile, what's going to happen is that you're going to be wrong more often. Your upside's going to be less, and your batting average is going to be lower, of course, because you're going to be wrong more often. So you've got to compensate for that, right? The only way to compensate for that is to go back to, what do we control? We control the losses, right? We control those sliders that we can move, versus the sliders that move on their own that we don't really have any control. We can just assess and measure and then adjust for those as they change. But we have some direct control over certain things. So first thing you have to do is you got to get off margin, because now, of course, you'd be leveraging a scenario that is worsening. Reduce your exposure. All right, position sizing and overall capital commitments. And the main thing is to be less forgiving. All right, so you tighten up your losses. And if you're normally cutting them at 7, 8%, well, now you cut them at 4 or 5, because a more difficult period, again, like I showed you before, even if you widen the stop, right? If you have for a wider upside, it doesn't pay, right? It doesn't pay. We looked at all those scenarios. It doesn't pay. As the batting average drops and you get below 50%, you start hitting negative expectancy, even though you're still at the same ratio. So you've got to improve that ratio. You also, on the upside, you want to be less greedy, because now you're not going to have profits as big, right? The market's in a difficult period. Profits may not be as big. So now you got to take what you can get and start taking smaller profits, and also the losses have to be tighter. So now I'm going to circle back to how I started. If you remember, I said when I first started, I was cutting losses. After a couple of years, I started cutting losses, but every now and then I'd slip, and I would hold a few stocks, and I'd let them go down, and they took that toll on my performance. Remember, if I adjusted them all to 10%, all of a sudden I had an 80% performance versus a 12% loss. So those moments, those occasional, what I call just this one time moments, you ever have where you're in a trade and you were going to sell it at down 5%, and I don't know, some news came out, but it's Amazon, you love the company, it's a big company, they're not going out of business, so you say, just this one time I'm going to hold I'm going to stick with this one. And next thing you know, you're at a 15% loss and a 20 and a 25. And then finally, after you're completely demoralized and you can't take the pressure anymore, you're throwing the towel and you take a loss, right? So you have to ask yourself, how many just this one time moments do I have per year? And I can assure you, it's not, if you have one, you have 10. There's never just this one time. Anybody who has it just this one time moment is breaking discipline and has many of them. Nobody just does it just this one time. So the key is to have no just this one time moments. That's your goal. Your goal is to get your game as tight as possible and never have a just this one time moment. Okay. And I'm going to show you at the end why that is. Okay. And give you another probability proposal. So if you're having trouble, okay, if you're having trouble in the market, you gotta break it down. What happens is people start having trouble in the market, and then they start breaking rules, and that's not the answer. The answer is to troubleshoot, find out what's going wrong, so you can make the adjustments that need to be made. So if you're having trouble, there's only a couple things that could be wrong, right? Either your criteria is flawed, because if your criteria is right, then things are going to be working. You're going to have an edge. So you got to check your criteria. Am I doing everything right here? Am I buying at the right point? Am I, setting my stops, cutting my losses properly? Okay. If that's not working and you're doing everything right and your criteria is solid, well, then the general market's no good. You're in a bad market. It's that simple. It can really only be those things, or you've got good rules and you're just not following them. So you've got the right rules, but you're breaking the rules. You're having that just this one time moment. So trading failures come from two things and two things only. That's faulty principles or faulty discipline. If you've got great principles, well, then you're going to do wonderful. But if you can have great principles and poor discipline, it doesn't matter, because now you're not following them. You're not executing them. So again, everything I do is to create the shortest distance between 2 points, to get rid of as much noise as possible, to boil it down to what actually works in the real world, and then to perfect that and to optimize it. That's the key. This is all about optimization, optimizing your buy points, optimizing your time that you're going to be, that the trade is going to tell you whether you're right or wrong. You want the quicker that can happen, the quicker you can move that capital somewhere else. So optimizing so you can compound, optimizing your math, trying to get the math to be as optimal as possible. All this is about optimizing everything. Now, just real quick, the benefits of measuring your results, because again, so few people do this. I've trained thousands and thousands and thousands of traders, and it's amazing on how little people know about their own trading. I call it the ostrich syndrome. They put your head in the sand. They just don't want to see the results because maybe they're not that good. So you try to just make believe and that they don't exist and hope that things get better. But there's such valuable information there. That's your best teacher. You're able to make much better assumptions. You're not able to make assumptions at all if you don't know those results. If you don't know your average gain, how the heck would you ever set your loss? You wouldn't know where to put it, right? You're gonna have more optimal loss cutting, because now you're gonna know the exact ratio. You're gonna manage the risk reward relationship better, which you won't be able to do unless you know the math behind it. It's also going to improve how decisive you are. Once you start knowing these numbers, you're going to have a level of confidence that is much, much more. You're going to have much more confidence because you're going to really know where you are. It's you're going to understand what's going on mathematically, and you won't feel so bad about taking that loss if you know that, hey, that's half of my average gain, and I know I'm getting $2, on the other side of the coin flip, and on this side, this is a necessary loss that is being cut at a fraction of my gain. So you're going to be more consistent, because you're going to be able to roll that edge over and constantly be making money, because you're getting odds. You'll never know to get odds unless you can measure this. And you'll also think much more strategically. You'll really start to see the landscape of not only just see the chart, but know the math behind your decisions. So when you're making a sell decision and the stock's up 20%, you know my average gain is 10. This is 2 times my average gain. I need to protect this, because if I protect this gain and I nail down that 20%, what did I just do to my average gain? I improved it. I now have a larger average gain, and that's the goal. The goal is to move your average gain as big as you possibly can and keep your average loss as small as you can, so you have the biggest ratio without being able to do it consistently and without choking off the trade. So if the loss is too small, well, then you might not allow the upside to take hold, right? Because you'll knock yourself out of the trade. So you're trying to find that optimal level where the right amount of risk and get that optimal amount that you can, the most juice you can get out of the proverbial lemon. At some point, that number, that upside number, is going to peak, and you're going to pretty much get all you can out of your strategy, and you'll have consistency, and you will know that number, and it's going to be a very consistent, reliable number. And then there won't be much to think about anymore when it comes to losses. It's just a mathematical calculation. So the next time that you're about to make a trade, what I want you to do is ask yourself a question and say, how is this going to look on my spreadsheet? Okay, even if you don't keep a spreadsheet, I want you to ask yourself that question, which you should be keeping a spreadsheet. But even if you didn't keep a spreadsheet, I want you to be cognizant of, how is this going to look on my spreadsheet? All right, I have this distribution curve. I'm down 15% and then and sliding. Where's that going to be? It's going to be way over, right? It's going to be way over to the left, that area that I don't want to be, right? I want them over to the right. So how is that going to look on my spreadsheet? So there's 2 types of stops. We're talking about stops here a lot. Let's go into some specifics about stops. There's 2 types of stops. There's a technical stop and there's a mathematical stop. At least this is how I break them down. I break them down into two categories. So a technical stop is, I'm looking at the chart and I'm saying, okay, if it goes to at this level, I'm out based on a technical breach, or the trade failing, the trade souring, and whatever that happens to be, whatever technique you're using, whatever strategy, technically the trade is souring. Okay, the other one is purely from math. So go into the trade and I say, hey, I want to risk $500 here. That's it. I set my stop at $500 and I'm out there. Or I'm going to risk 6%. All right. That's it. That's all I want to risk is 6%. Doesn't matter what the technicals look like. So what I try to do is I try to marry the two. And that's where the stop, the risk becomes an actual selection tool. And most of my stocks, or pretty much all my stocks, are selected based on that, based on risk. So I'm backing into that risk. I'm looking for a technical setup that, when it technically sours, it makes mathematical sense at the stop that tells me technically this stock should be sold, but that technical out is not larger than what my prevailing math demands. Now, if it is, let's just say there's a stock that's a bit more volatile, and my average gain is X, and in order to get stopped out technically on this stock, below the base, below the pivot, wherever you want to use that technical out, it would be too much risk. Well, then I would go with a mathematical stop, and I would say, okay, what's the maximum that I can risk here based on what I'm pulling out of the market on average? And I would use the mathematical stop. Let me show you how this works here. So here's a stock that I traded, there's no symbol here, right? Yeah, I think from looking at this chart, I think this was ACAT, A-C-A-T. I'm pretty sure, if I remember here. But I bought this. You had this post-gap little setup here, turning up. And you see the stop is right here. And I sold this into this strength. And you can see, again, the green is a much bigger amount than the red, right? Okay, so I don't control this. I don't control this upside, right? But I do control the downside. So now I'm looking and seeing, what have my trades produced on this upside? So whatever these boxes are, I'm thinking in these terms of these 2 boxes at all time. So basically, when I look at a chart, I overlay the upside box in my mind. And then that tells me I want the downside box to be half or less than the upside box. That's simple. All right. So this also is known as trading near the danger point. So if the low of a base, the low, wherever it technically sours, the closer you can get to that level, the tighter your stop's going to be. So you're backing into the trade based on that low making mathematical sense. So in this particular instance, this low made mathematical sense. I looked at the trade, said, okay, I'm going to enter here, and if it takes out this low, I'm out. Well, what's that percentage? That percentage was perfectly fine with what my upside, with what the ratio of my upside. So now I know that my upside on average is paying for this amount of risk. Okay, that's the thing to determine, is your upside paying for the risk? Let's look at another example here. So this is Medivation. So this actually broke out a couple times. It came out of here, power play type, came back in, based a bit more. I had missed it a couple times, and then finally it just looked like this was really a nice uptrend here. It came back 4 or 5 days down, came back to the 20-day. I said, you know what, at this point I'm just going to buy this turning up. It looks like a nice little natural reaction. If it truly is a natural reaction, boom, it should just go. I'm near the danger level. I'm back by the base. If this comes down much more than this, it's really starting to act normal and act abnormal. And I know that, I should just sell it so that there's not much distance there, right? I'm trading near the danger level. So if this didn't just go, I'm out. That makes mathematical sense. And I'm near the danger level. This is how you do it. This is how I do every trade that I trade. I'm basing it on the same risk reward analysis, and I'm using my results as my assumption. All right, let's talk about another big weapon in your battle to manage risk, in your risk management toolbox, if you will. And this is one that is really, I think, completely misunderstood. Let's just start off by just saying that trading is not an on or off business. You don't have to make an all or none decision. It's not green light, red light. It's incremental. Okay. The main thing is to always remember is that small success leads to big success. You don't have to jump in with both feet into the market. You're in cash. You don't have to go from cash to 100% invested. And I'm going to show you some numbers. When we go to mind-blowing math, I'm going to show you something that's going to blow you away as far as holding cash and as far as position sizing is concerned. So another big benefit of keeping that ratio, as we've been talking about, maintaining that reward risk ratio, is that you can be right one time out of every 3 and not get yourself in trouble, right? So let's take a look at what that looks like. So let's say you start off with, you're a trade, and you make a trade. You set a 4% stop. It's $1,000, right? And you sell it 2 hours. You sell it at 8%. These could be any numbers. The main thing is that we have a 2 to 1. All right. Now you've just banked yourself $2,000, right? So now your next trade, you go in and you take that 4% stop, and now what you have 2 trades, right? You can be wrong 2 times now because you've just financed 2 trades because you're 2 to 1. So now if you were to lose in the next 2 trades, you're just at break even. You're right back to break even, right? So let me show you how this works. Now, a lot of times what I'll do, this is what I call progressive exposure. And this is such a powerful, as a matter of fact, most of the students and the members and the clients that I've had over the years, the ones that really start to do well, and I talk to and they tell me, their sort of their road, their journey, it's unbelievable. I'd say like 8 out of 10 of them always say progressive exposure really was the game changer. Like that was the thing that I didn't understand completely at first. And once I really started to use it properly, it really made a huge difference. And it's the same for me. I mean, the progressive exposure and really learning how to use progressive exposure has been just an amazing thing for me that has changed my performance dramatically. See, the goal of in trading is you want a system or a strategy that automatically gets you to, before forces you to trade your largest when you're trading your best and your smallest when you're trading your worst. The reason why is because you want to be able to pyramid into a bull market and be heavily invested when stocks are going up. And you want to be able to pull back and get lightly invested or get in cash when things aren't working. So now you protect yourself in the bear markets and you expose yourself to the opportunity in the bull markets. So if you start using emotions, it's very difficult to get that right. So the way I do it is, and I want to let the market, regardless of how much I think things are going to go up, or, I'm positive or negative on the market, I want the actual results to confirm that. I'm always looking for the results to confirm that. And as I'm getting profitable, I start moving my exposure up. And if things aren't working, I start moving my exposure down. And I'll do it very rapidly too. Once things are working, I'll move up very quickly. But until they're working, I'm going to be very careful. So let's just say your full position, your largest position that you would trade on a full position is 25%, right? You've decided that that's sort of my, that's my optimal large position size. So you're coming in from cash, right? Maybe there's a correction or a bear market. So I might take a quarter position, a quarter or a half position. And I go in there, and again, same scenario as before, 2-to-1. I risk $500. Stock goes up, I make $1,000, right? Okay, so now what that does is that gives me enough to risk for a double size position. I can now move my position size up to 12.5% and still break even, because I made 2-to-1. So now I go 2-to-1 on my next position size, right? So let's just say I get another winning trade. Now I pull $2,000, right? So now what that did is I banked 1,000, I banked 2,000. That allows me to not only double my position size to 25% now and expose myself to even bigger opportunity, but also if I lose on that trade, I can even take another trade at a half size position, 12.5%. And if I lose on both of them, I'm just right back to break even. You see? So what I'm doing is I'm letting the profits finance the risk. And when you keep that ratio, when you keep the ratio where you're making more on your winners than you're losing on your losers, what happens is that you can start small. You can start with a smaller position, because now you're getting that multiple, and now you can take that money and you can finance a larger position. This is what I call financing risk. So you're financing the risk. You're financing the risk. If this went the other way, you'd be doing just the opposite. Your positions would be getting smaller, but you're already starting in a small position. So you're not risking much. You're only risking when you have some dollars to work with. All right. So I do the same thing in poker. Like when I first started playing poker, some people think this is, will disagree with this approach. What I do is when I start playing poker, in particular in a cash game, I'm talking about a cash game where I've got time. There's no a tournament where there's time against me. I have all the time in the world, right? So I start off and I play conservative. I build my stack. Once I start getting a stack, then I get aggressive with those chips. I don't want to go and go into the hole and have to work myself out of a hole. Now, some people will say, well, the probabilities are the same. It doesn't matter. I mean, it's just one big long game. Yes, but the problem is that the probabilities distribute correctly over 100,000 hands, 1,000,000 hands. All right. Not in 40 hands an hour over, an 8-hour session. That's statistically insignificant. You know how many days you can go bad? Just like in the stock market could go negative and go against you a lot longer than you're solvent. So you can't think, in the big distribution picture when it comes to risk, because there's risk of ruin. If you get stopped out too many times, you get death by 1,000 cuts. So the way to protect yourself from that is to risk only a little until you start working with some profits. And then you let the profits finance your risk. This is why, it's not like this secret why I have very small drawdowns, but I have big upside, because I'm exposing myself only to the upside when I've got the profits to work with. I'm never opening up my nose. It's the same thing with poker. I very seldom have big drawdowns with poker. There are sometimes I do, but very seldom because of this principle. It's a universal principle when it comes to speculation, when it comes to gambling. So again, your goal is to trade the largest when you're trading your best and trade the smallest. Now take a look here. Let's say we got 3 trades in a row, and we pyramided. So we use progressive exposure. We start off with a quarter position. We make $500. We go to a half position. We make, of course, we've stepped it up from 6.5 to 12.5%. We make $1,000, right? Okay, third trade is we make $2,000 because now we doubled it again. So we progressive exposure into 3 trades. Now we've just banked enough to trade a fourth, a fifth, a sixth at full positions and a half position. We just financed 3 full positions and 1 half position. And if we lost on all of those, we'd be back to break even. As opposed to you just go in there and you just go hog wild. First few stocks that set up, you take big positions. They don't work out. Now, boom, you go in the hole. What does that mean? Losses work geometrically against you. You see? So now you've got to come back from a loss. It's harder to come back from a loss. That's why we want to protect the downside, because the downside works against us harder. The more you're down, the harder it is to recoup. So we can't ever go down big because now it works geometrically against us. Understand? Okay, so let profits finance your risk. How do we do this? We start with relatively small pilot buys, right? And you're not going to get aggressive until you're profitable. You start off with 25% positions, 50% positions. There's no reason whatsoever to step it up if your last 4 or 5 trades are losers. All right, I'm never going to step up my exposure and my position sizing if I'm losing. If my last 4, 5, 6 trades are losers, I'm probably going to trade smaller. I'm certainly, if I trade the same size and I get another little string of losses, I'm definitely cutting way back. So until I get that progress, I'm staying put or I'm trading smaller. All right. This is the general rule of thumb at all times when you're trading. Now, what happens sometimes, you'll start small, things start taking off, you pyramid up, and then just when you get to big positions, things turn around, you get stopped out, you come back down, you cut back. Just when you get at your smallest positions, things turn back up. I call it the zag-zig. You're zigging when you should zag and zagging when you should zig, or the market's zagging against your zig, right? So that's going to happen. That's going to happen. But that's again, it's an insurance policy. All right, because the thing that you got to realize, though, is that when the market trends, you're going to pyramid right into that trend and be fully invested. And when the market rolls over into a bear market or a serious correction, you're going to cut back where you're not going to be heavily invested on the downside. So you want to protect yourself from that downside and make sure that you're exposed on the upside. There's a price to pay for that. The price is in a whipsaw market. You're going to get knocked back and forth a bit, and you're going to have to adjust for that too. You might have to cut back and just stay at some smaller positions until things are working. All right. So we're going to cover just a few more things here, and there's still a lot to cover, but I know I'm taking you pretty quick through each thing, but let's move to trading priorities for a second. So when you first start a trade, it's all risk. You haven't made any money, so you don't have any. There's no cushion. There's no profit to finance your risk. It's all risk, right? So your very first priority is to cut your loss, is to set the stop loss and to minimize the loss to keep it as small as possible. That's your main priority. That's really your only priority, is to buy the stock at the right point, but make sure that you're keeping that loss small. So now the stock becomes profitable, right? It starts moving up. Now you have some options, right? So now once the stock starts moving up, now you've got some profits to work with. And now what becomes a priority is protecting your break-even point. Again, these are the keys to not having big drawdowns, is to, as quickly as feasible, to start protecting your break-even. So now there is no loss, right? You're free rolling now. The worst case scenario is you're going to break even. That's what you're always trying to make your worst case scenario serve you. So in the very first worst case scenario is getting hit with the stop. So you want to make that as small as you possibly can. The next worst case scenario, once the stock is profitable, is now you protect your break even. So now you've improved your worst case scenario, right? Your worst case scenario is a break even. Okay, so now stock maybe gets a really nice profit. Now you've got a decent gain. You don't want to give a decent gain back. You want to try to nail that down. So now you move to the next priority, and that is protecting your profit. Now your worst case scenario is having a profit. See, but now if you don't think in these terms of progressive priorities, what's going to happen is you'll get a gain and you'll just start getting pie in the sky and saying, oh, this thing's going to the moon, whatever, it's Tesla, this, that. And now you're not thinking of protecting, you're not making your worst case scenario, nailing a profit down, and maybe you let the stock come all the way back, and before you know it, you're at break even or you're taking a loss. So this is how you think in chronological order. Once you go into a trade, these are your priorities as the stock progresses and starts to turn profitable. Now, again, here's a rule, a hard rule. Never let a good size gain turn into a loss. Right. So when it comes to protecting your break even, what I generally do is that once the stock goes through, remember we talked about natural reactions and tennis ball action. Once the stock goes through a natural reaction and then takes out the high of the natural reaction, which would be, it's natural because now it's moving to high ground. I got the tennis ball action. So now I deem that as a natural reaction. If that gain is at or above my average gain, I then move my stop to break even. That's sort of an automatic adjustment. So now I move my worst case scenario. My worst case scenario now is break even. Now that stock turns even more profitable. I'm never letting a good size gain turn into a loss ever. That's one of the big mistakes that I did early on. Is I'd have a decent gain. I'd be up 30%, 40%, and then the stock would come down. And maybe one day gets cracked. It's down 10, 12%, and now I'm only up 15%. I'm like, oh man, I should have taken that 30% gain. If it just comes back a bit, I'll take it. I'll nail down 20%. That's enough. Next thing you know, it's down again. Next day, I'm only up 6 or 7%. Now I'm like, well, it's too late now. I might as well hold it. It's only up 6%. And boom, next day the news comes out. Gap goes through my break even. I'm at a loss now. I ended up, taking a loss on it. Never allow that to happen. Once you're at a decent gain, look to nail down the profit. If you don't nail down the profit, make sure you protect the break even. Full size retracement of a good size gain is a sell signal. So this is a rule that I learned way back from O'Neill and David Ryan when I was going to their seminars back in the 1980s, and this is a rule that I've kept ever since. So when you I remember I talked about options. You also have, when you get at a profit, you not only have options from a mathematical standpoint, you have options from a psychological standpoint, because your confidence in your psyche is real important. You want to protect those just as much as you protect your portfolio. And one of the ways to do that is to always try to put yourself in win-win situations mentally. So if a stock goes up, all right, and you're indecisive, right? You're like, I don't know if I should sell it here or what. It's a nice profit, but I think it's going to go higher. I like the company. Sell half, right? If you sell half, you're in a psychological win-win scenario. Here's why. And it only works by selling half. If you sell 60% or 70% or 30%, it doesn't work. It has to be an even amount. You have to sell as much as you hold, because when you do that, if the stock goes higher, you say to yourself, boy, thank God I held half. If it goes lower, you say to yourself, thank God I sold half. Either way, it becomes a win-win scenario, right? So you can justify it. But if you sold 70%, well, now if it goes one way, it's it's not equal each way, right? One way is worse than the other. So selling half, cutting the position in half. And again, I usually do this when I have a decent profit. And I want to take some of it off the table, but maybe I want to play it for a bigger move. And I just sell half. Now, when you get at that scenario, we talked about free rolling, right? So there's two things you can do. This is really powerful. So pay attention. You can free roll your stop, all right? Or you can free roll your break even point. And let me explain the difference. So you move your stop up to break even, right? Stock goes up 20%. You move your stop to break even, right? It goes to the natural reaction, new high, stock comes to break even. What's your worst case scenario? Break even, right? Okay. So, but that is going to stop you out. The stock comes back down to break even. It's going to stop you out. It's going to give the stock less room, right? So maybe the stock's not up a lot. Maybe it took out that natural reaction high and it's only up. Your average gain is maybe 8 or 10%. It's up 11, 12%. So it's not a very good distance from the breakout. You might want to still give it some room, right? So another thing you can do is you can sell once your stock gets at where it's the number equals the stop. If you sell half, you could actually keep your stop at the same level and you'll finance your stop. Your stock will come down. Let's say you start off with 8% stop. Stock goes up 8%, you sell half. Well, now if it goes down 8%, you just financed the stop. So now you break even. You still break even. Worst case scenario, break even. See how I'm always trying to put myself into where a worst case scenario is break even or better. That's where I'm trying to angle into. I'm always trying to angle into that. And before I can get into that scenario, I'm trying to make sure that I never just charge in and put myself at any great risk until I've financed that move. Until I finance that more aggressive move. And while you start doing these things, you can see the chronology of them. That this is how you build into your exposure and you reduce the risk. Let me show you what that looks like. So again, here's where the stock breaks out, cheat area. In this scenario at 1 right here, you set your stop below the low of the pivot. Stock runs up, right? Now it pulls back and then tennis ball action. See at 2 here, it takes out the high in the natural reaction. So now you move your stop to break even. So now you guarantee yourself a profit. You're at break even or better. Now, if you were to sell half your position here, you could keep that same stop because now you're at a multiple of your loss. You're financing that. And the bigger this is, the less you have to sell. If this is at a really big multiple, you can sell even less and you will finance that stop. Now, if it's at, let's just say the stop is at 5% and you're up only 2%. Well, if you sell more, instead of half, you have to sell more than half, and you might be only left with a small position, but you could still finance that stop. So you can do the math, but the key is to angle yourself into a free roll. All right. Now, another technique, I've segued into position management techniques, but it's still all from a risk. It's all from a risk, from a risk standpoint. But again, by minimizing this risk and angling yourself into these free rolls and to financing the stops, you're putting yourself in a position to take a small amount of risk. But remember, there's still all the upside. There's still all the upside. These stocks can go indefinitely. Some stocks, Amazon's been going up for the last, 10, 20 years, 80,000%. So the key is that you want to make sure that you're not taking too much risk, right? You want to, once you get into a situation where, you've de-risked the trade, and now it's all upside. All right. Let me show you another thing here. This is the reduce and add back. So let's just say you start off, you're buying from the cheat, right? We talked about cheats. It could be low cheat. You're buying from the cheat. Stock breaks out, pulls back, takes out the natural reaction high. Now you move your stop to break even, right? Okay. So now you only have half the position, but the stock is still in a base. This is the power of trading the low cheats and the cheats. You can actually get some trades and trade around your core position and get profitable and build the profit up to finance your trade within the base before the stock even really breaks out and starts making that real big move. So you run up here, and now, because sometimes, you know, your cheat area is low enough where getting back to the old highs where you might set a handle and finish that VCP, that could sometimes be a 15-20% profit in itself. So even if you had a 5% stop or an 8% stop, it makes mathematical sense. You got a 2R trade just within the base. So in this scenario, we sell half into that strength, right? And now it starts tightening up and building that full, coupled handle VCP. Now, as it comes out of that base, we add back and we move our stop now on the whole position. So now what happens is that this new stop becomes a stop loss on the new shares, but it also becomes a trailing stop, or it's not a trailing stop, it's a backstop. It becomes a backstop on the old shares and actually locks in a profit, right? So now you're net, you're free rolling and you're adding back. This is trading around your position. So you can have a core position, you trade around it in and out, and then you add back. But as you move your stop up, you accomplish two things. You take the risk off. You minimize the risk on the original, on the new trade, on the new edition, and you backstop the old one. Let me show you another way this works. I'm going to actually skip this page because this really just shows the exact same thing. This was an actual trade that I did. But let me go. Here's another trade that I did in Rambus. So on page 424 here, I traded it here at B. I sold it into C. This went up 63% in 5 days. I mean, that's a serious profit. Then it reset, and I came back into it here into a half position. I sold half my position into that first move, and I sat through this base building. And then when it came out here, I added it back, and now I've got that full position on again. I'll do that sometimes. I mean, sometimes 10 times in a move where I go in and out and in and out. Sometimes I sell the whole thing. I come back into it. Sometimes I sell half of it, and then I add it back, and I just keep reducing and adding back all the way up every base until finally it comes back. It stops me out, and that stop hits is a stop loss, and it locks in the profit on the original shares. All right, I wanted to get to here, the add and reduce. So this is another money management technique. Again, where I'm always angling, right, to reduce my risk and increase my upside. So in this scenario, what you're accomplishing is you're adding shares without adding risk. And the way you do that, again, this works great from, and all these things. Remember, I told you everything that we start with, anything that we say prior, doesn't get negated or doesn't change by what we say now. So everything is built. This whole workshop is in chronological order where everything builds on everything builds. All right, it builds forward. So all these techniques are all based on this works great with the low cheat and the handle, and all these things are all in chronological order. So think of it as you find a stock, it's setting up a low cheat, right? Or a cheat area. It comes to the pivot point. You set $1 stop here, right? So whatever that percentage means, it doesn't really matter at this point. But you set $1 stop. So what that means, you buy 1,000 shares, you're risking $1,000. At $1 stop, you're risking $1,000, right? Okay. Stock moves up, right? But it builds out a nice base and really tightens up on the right side. It gives you another buy point. Okay. So now we'll call it in this scenario, we're calling it in this example, 1850. We started at 1650. We bought 1,000 shares at 1650. So it ran up. Now it sets up even tighter here. It starts coming out of this base. I add another 1,000 shares at 1850. That now gives me 2,000 shares at an average price of $17, right? But I put a $1.50 stop here. Why am I putting that $1.50 stop? Because that's $1,000 risk. So what I'm doing is I'm keeping my risk constant, but I'm moving my size up. See again how I'm financing the trade. This is another money management technique. It's what we call the add and reduce, averaging up without adding risk. This is one. There's so many permutations. I'm sure if somebody was really great with math, you can come up with all kinds of scenarios and really get mathematical about this. And if you have any of those scenarios, please share. Email them to us. I'm always open-minded to whatever permutation you can come up with for money management techniques. But these are some of the basic techniques that are sort of the bread and butter, of my trading. It pretty much, 90% of everything I do comes down to everything I'm showing you here. There's not many, there's really not many tricky things that are, complicated. It's real straightforward. I'm a big fan of Vince Lombardi, and he used to tell his players, look, we're going to learn how to block, tackle, kick, run, pass. We're going to do the basics, but we're going to do them better than everybody else. We're going to master those things where we are going to be unbelievable at those basic fundamentals. And that was his his methodology was to perfect the basics and to be better than everybody else at them. And that's exactly what I do. These are, and these may, I call them basics, but this is complex stuff. This is a lifetime to get to this point, to put all this together. You see, we've come a long way. I mean, we traveled from days and days ago, starting off with the trend and going through pivot points and bases and, cheat areas and low cheats and VCPs and, all kinds of stuff to get here. There's a lot. But if you look at it in a chronological terms and you see how everything builds on each other, you'll start to look at that right side of the chart and look back and see everything, and you'll see that chronology. This is just getting to the point now where we're managing the position. All those other decisions have been made. We already know we're in an uptrend. We already know it's a base. We already know it's a cheat area. We already know where the pivot point is. We bought it there. We set our stop. That's all done, right? Now we're managing the position. We're managing the risk. All this is all about making decisions in real time. Everything I've shown you is all about making the decision now. Making the decision right now. And then the next moment, you make another decision, but making decisions in the moment. Here's an example. I put this trade up because I remember this trade really well. It was one that was not the best trade as far as when I say not the best trade, not the result, but this gap up and this little base with this cheat area, it just wasn't the greatest setup. It was a short little setup on extended. I very rarely do well with these. I tried it. I say this may just go here, and it did. I had a little gain right off the hop, and then it's set up where I did the add, right? I added here the second buy, but then I moved my stop up on the whole position. So now it did fail. And see, this is what I'm trying to protect against. As I'm pyramiding up and adding more money to the trade, I'm increasing my size, I'm increasing my risk. So by cutting that off, I'm now getting the upside, but I'm mitigating the downside, right? This stock tried to come out squat, then came in, stopped me out. So I was able to add to the position, bump it up. If it worked out, I moved myself into a bigger position, but it didn't. I didn't lose anything. I break even on the trade. Okay, so now with everything that you've just learned, and again, some of you will know the answer to this because you've been to the Master Trader program, and maybe some of you have heard me speak before. But let's just talk about and think in terms of risk versus reward. Okay, and with everything that you've learned up to this point, is this trade a good trade? All right, you come out of a base here. All right, let's just all agree that this is a decent base. It's got VCP characteristics, breaks out here. We set a 6% stop. Stock runs up, goes through a pullback, has a gap. We can say earnings, whatever we want to call it. Profit is taken at 41%. You risk 6%. You took 41%. Is this a good trade? And if it's not, what's wrong with this trade? Or what's right? What's wrong? All right, let me show you. Another key rule is to always evaluate your position and always evaluate every decision you make on a risk-reward level. That means that not just initially, every decision is based on risk versus reward. So when you first buy the stock, it's all risk, right? So the stock runs up. Now, this trader is up 29% on this trade. A nice ratio, right? A really good ratio, 5-1, whatever it is here. Really nice ratio. Now, holds the stock down 16%. And then when the stock comes back up, sells it when the stock is up 41% from the purchase price. Sounds like a pretty good trade, right? Well, let's look at the decision that was made not only here, but right here. So letting it drop 16% might be fine if you didn't know, if you knew in your head, if you said, you know what, if this trade went to $24 and I was up 40%, I'd sell it. If you know that, if you had known that, well, then to let it drop 16% wouldn't make any sense, because from 29% to 41% is 8 more percent. And you have to always think in compounding, right? You have to think compounding. So for it to get from 29% to 41%, this stock only has to go up 8% more. So what happened is that you were in a position where you can nail down a profit and nail down a 5-hour trade. And instead now you've inverted the risk reward, or the reward risk ratio. You now risk 16% for 8% and gave back almost all of your 29%. So this is not the greatest trade. This is not the greatest decision-making process if you knew you were going to sell. Now, if maybe you're trying to play this for a much bigger move, and in your mind, you wouldn't be selling at 24%. I'm sorry, at $24. Well, then, yes, you might be, that's your decision at that point. But from a mathematical standpoint, again, you have to ask yourself, where am I a seller? If you know you're a seller here, well, then that decision to get there, you need to now figure out what is it going to take to get there? How much gain is that? So your stop should have been set at half of that 8%, and backstop is 4% off the high if you know you're selling here. And very simply, you want to evaluate your position every single day. And what I do is I ask myself these questions. There's a couple of questions that when I'm in a stock, I ask myself, would I buy it right now? Okay, so the stock's up, and it's up 20% from my buy point. Well, no, I wouldn't buy it right now because it's extended, right? The stock's extended from the buy point. Okay, then why am I holding it? And where am I a seller? Where am I potentially a seller? You'd be surprised at how many times that we sit there and we hold a stock and we'll let it drop 5 points, and meanwhile, it goes up just a couple more points from where we were, and we're selling it. And again, we've inverted the risk reward, the reward risk ratio. It just doesn't even make sense. And that happens when you're not thinking risk reward, you're not thinking math, you're not letting the spreadsheet make its way into your trading. So every decision needs to be a risk reward decision. So I'm holding it right now. I'm not a buyer here, but I'm holding it. What do I expect from this? Where am I a seller? And if I can nail that down, if I get an idea of that, then I know where, again, to set my stop and to backstop it and to manage my risk. Let's look at another trade here. So this was Body Central. I actually traded this stock. I spoke about this in the primary base section. This stock came out, and I just sold it right into this move right here. Nice quick gain. It ran up 40%. But again, if you were to hold this stock and let this come all the way back down and then sell it when it was up 78%, you got right at the high here. That may feel like a great trade. But what you did was you took a 40% profit and you risked it, and you risked 27% to make 27% when you already had a 40% profit. So you gave back the 40% and you risked that whole gain and let the stock drop 27% to make 27 more percent. So really, you should be looking at that 20 if you knew you were a seller here. Again, if you don't know, if you're playing it for a much bigger move, this might make sense. I would never let a stock come down this much and give all that back. A 40% gain, I'm never letting come all the way back to almost break even like this. I'm going to nail some of that down, probably at least 30%. Maybe let it come back 10%, or I'm going to sell half of it, or maybe even 3/4 of it, and then I'll play that other part for a bigger move because I've now taken the risk off, or taken some of the profit off. So again, just looking at this from a risk reward standpoint, you look at it like this, and you start really thinking in terms of risk reward, even from wherever you are in the trade, not just the initial decision. I just put this on here because, and this is in my, I think it's in my first book. Numbers, they say if you torture numbers long enough, they'll tell you anything you want to hear. So you have to be careful on how you look at numbers. And if you look at them properly, and they can serve you and you can really empower you, but they can also confuse the crap out of you. All right. If you're not careful, this is a perfect example. When you start dealing with large numbers, when you're dealing with losses, they work, like I said, geometrically against you in a pretty sinister fashion. So, in this example, if you just alternated 50% gainers with 40% losers, and you compound it versus not compounding will bury you, because again, the 40% is such a large number versus the 50% that losses work geometrically against you. In this scenario, it would be better off not to compound, that's not really possible to do. That's not something that's realistic. You want to be able to compound. So what a lot of people see this and they misinterpret it. The key of this is to show how powerful numbers can be, depending on how you interpret them, and also to show you that you have to, in order to compound, you've got to have your losses smaller than your gains. That's what this whole section is all about, is maintain that risk reward relationship, and preserving its integrity. So another big risk is holding into earnings. All right, holding into earnings is another risky scenario because you can get these big gaps. So people ask me all the time, do you hold into earnings? How do you hold into earnings? Well, sometimes I hold right into earnings. I'll never hold a big giant position into an earnings report unless I have a cushion, unless I've had some big profits behind it. But generally, I'm looking for some type of cushion in the stock. Maybe, depending on the volatility of the stock, it might be 5, 6, 8%, 10%. If you have a 10 or 15% gain, that's more than enough to hold into an earnings report. Even if you get torpedoed, you're probably still going to take a loss that you normally would have taken anyway. So again, wherever my stop is, I'm hoping that I have at least a gain the size of my stop or a multiple of it. These are just a few examples here of buy points and then where the earnings came out. I'm not going to get into these too much, but I want to show you this here. So one of the things you can do, and this is only available if you if the stock has options. So if it does have options, and also if it doesn't trade much and it's real thin, you're not going to get as accurate of a reading. Something like a Netflix or an Amazon or a Google, this is going to be tremendously accurate. It's going to be so close, you'd be amazed. And this is just figuring out how much the price is likely to move on the earnings report. So what you do is you go and you take, this is the formula. There's actually a more complicated formula, but this is absolutely good enough. This formula is close enough and will give you a very accurate reading. You find wherever your price is, so say the stock price is trading at 162 in this example, you find the closest strike price. So in this example, we found a 160 strike, right? So then you take the ask prices of the calls and the puts and you add them together. So in this scenario, you've got 350 and you've got 275, that would equal 6.25, right? So now you divide that number by the stock price, and that's going to give you, and you can move the decimal or times it by 100. that's going to give you the percentage that stock is going to move in either direction. And it's going to be very close. It might say 8% and the stock moves 9 or 10. But generally, like I said, if it's a real liquid name and it's pretty widely followed and it's got a lot of options, this will be a pretty accurate. So this is another way that I hold into earnings. Whenever we go into earnings, I'll ask my assistant, what's the volatility? What's the options pricing saying? So, that's saying that there's going to be an 8% move. Okay, so now I got to look and see, do I have an 8-10% profit on the stock? If it says it's going to be a 15% move and I'm up 2%, that's one that I'm going to probably reduce or sell. If I'm up, 8% on the stock and it's saying, it's going to be a 3% move, even if it's double that, I'm still pretty much covered. So another way that you can determine to hold into earnings. So now another thing about stops that I want to point out here is that I talked about 8% being my max, and that's been the number, that the O'Neill number for decades and decades. It's a good max number. It makes mathematical sense. You could need a smaller number than that if your average gain doesn't support it. But I will go above it on a staggered stop. Sometimes I don't go above it by much. Usually it's only by 2% and sometimes by 4%. I might go to 10 or 12, but that's only on what I call a staggered or a bracketed stop. So with a staggered stop, it just means that you're just using multiple stops to arrive at the same number as if you used one stop. So or your number that you would want to end up on mathematically. So say you want to end up on an 8% number. So you say to yourself, well, I'm going to go into this stock and I'm going to set an 8% stop. Well, if that's a real volatile name, or sometimes in the beginning of a new bull market, you're coming off a bear market, I want to make sure that if I grab a key leader, that I can hang on to that tiger's tail. And I would rather have a half position in Amazon, in 97 when it was breaking out, than that's fine. I mean, that would have been an amazing amount of gain that would have added to my portfolio, even if I had a little tiny position. So that's because you're grabbing them at the beginning of a bull market, a key market leader that can make a huge gain. So I don't want to lose my position in the stock. I want to make sure I have some position in it. So under that scenario, I might stagger a stop. So even if it comes down and it goes a little bit below my stop, I'm still in part of it. Now, what you're going to do is you're going to give it up on half this position. You're going to actually take a tighter stop, and the likelihood of getting stopped out is going to be greater. But on the other half, the likelihood is going to be lower. So you sort of get a balance. So very simply, if you want to arrive at an 8% stop, if you stop out half at 6, the other half at 10, that's a total of 16. Divide that by 2, that's 8%. If you do it at 4 and 12, you still arrive at 8%. Now, that doesn't mean, you do 1 and 15. That's not going to work. All right. You're going to definitely get stopped out on the 1 and the 15, again, you'd be at that 8%, but you're almost certain you might as well just take a half position at that point, because you're almost certain to get stopped out at the 1. So within reason, generally these will be between, 3 or 4%. And 6 and 8%, and on the upside, or the largest stop, 10 to 12%. So this is how you can use. My stops, basically, I break them down into really tight stops, or 2 or 3%. That's like the tightest that I'm gonna, unless I'm day trading. Those are the tight stops. The average that I will, my stops in good markets, my average loss is probably about 3.5%, 4%. In tough markets, it's 5-6%. I average about 5%, but a lot of them, in a bad market, are going to hit the maximum 8%. In a good market, there's going to be less, and they're going to be smaller. My max 7 to 8%. My absolute uncle point is 10%. Like I said, even with staggered stops, I'm almost never going above 10%. Let me show you how this works. So this was a stock that I traded, ISIS. It broke out and then pulled back here. And again, at a 6% stop, this went down 6.1%. So you just got nipped out of it, right? And then boom, it turns back up. So if you had a 4 and an 8, you would have stayed in half the position. And then, if it turns back up, you get stopped out at that half and it turns back up from a pullback buy, you can always add back that other half. I mean, if you get stopped out, you could add the whole position too, but it makes it a little bit easier and sometimes will keep you in, a part of the position. Again, here, and again, I talked about lower lows, right? If the lower lows are within a base, it's building a handle, it's building a pivot, there's no real volume on it, the percentage loss isn't that great. You want to try to wait and give it a day or two and see if you can get that rally from that third or fourth lower low. You get 5, 6 lower lows. It gets more, every lower low after 3 or 4 lower lows gets more ominous. So it definitely would be a bad sign. And you are getting some violations, but it's got to be looked at as how big of a percentage is the decline? Is there volume on the lower lows? Are you below the 20-day, below the 50-day? If you're not, you might want to hold it. But again, here's a scenario where you come back, break out. This was Yelp. Breaks out of this little cheat area, runs up for a couple of days, comes back on what's a pretty natural pullback, and on that third lower low, it closes well, and then 2 days later, bang, tennis ball action. You see 3 lower lows, but the stock only traded down 3.5%. So again, if you try to stick with your original stop, and if it doesn't hit that, stay with the trade. Don't just get too crazy about the violations. If they start piling up, fine, but look around that third day, that fourth day, look for support and see if you can get that tennis ball action. All right, so we're just about at the end of risk management here, and I saved what probably the most asked topic or most requested topic is position sizing. I look at position sizing or approach position sizing very, very straightforward. There's not a lot of moving parts here. All right. So let me explain it to you. First of all, you don't want to ever risk more than 1.25, 1.5% to 2.5% max of total equity. And what I mean by that is that of your total account size. So if you have a $100,000 account, you don't want to be risking more than $1,250 to $2,500 on any one trade. Now, 2.5% is if you're good at this. You've been doing it, you're experienced. That's too big of a number for a newbie. Now, on the other side, you don't want to be risking too little either. If you're risking 0.2% of total equity, you're not going to make any money because you just don't have enough skin in the game. So that's why the 1 to 1.5% is sort of an optimal level. Now, that has to happen within the confines of an 8% max stop, 10% on staggered stops, maximum stop per trade, and you shouldn't average more than about 5 to 6% on the downside. If if you're averaging 8%, that's too big. That's too big because that's your max. So if it's the max, then you're going to have stops that are less than that. You should have less. So you should be averaging about 5, 6%. General rules for position sizing are never take a larger position than 50%. I shoot for 25% positions for my big positions. Now, of course, trading in the last U.S. Investing Championship, I've been taking very big positions intraday and really gassing it because I'm up against some really great traders that are super, super aggressive. And I've been doing this for almost 40 years. But really, you want to be very careful with that and try to keep your position sizing no more than 25% and the absolute max 50. Shoot for 4 to 5 good sized positions and maybe 8 to 10, 12 stocks. If you're trading a pretty big portfolio, maybe 16 names, that would be a lot for me. 16 names is a lot of names. I would try to keep it at 8 to 10 names or less, even with a good amount of money. You should really keep it quite concentrated. Let me show you how I approach position sizing and how the math of it works. So let's say our desired return is 40%. That's what we want to make. And depending, we're not even going to look at time frame. That's, we want to make 40%. All right. And we're trying to determine how long that's going to take. So our average gain is 12%. Our average loss is 6. Our batting average is 40%, right? We're right 4 out of 10 times. Using those numbers, this is not taking compounding in effect. This is just, straight trading with the same amount of money. 334 trades it's going to take to get to that 40%. All right. So position sizing, I said this before, where if you have an edge, turnover is great, and big positions are going to work wonderful. When it turns against you and things aren't going so well, big positions are going to hurt you, right? And turnover is going to chop you up because now you're turning over those losses and they're adding up. So let's take a look here, and we raise the position size, right? We raise it to 25%, and we have that edge, of course, right? Average gain 12%, average loss 6%, 40% batting average. This is a little less than 2-1, but still you've got an edge there. So now at 25% position sizes, you're only going to need 134 trades, where before you needed 334 trades, right? So now maybe, you can do 134 trades in 6 months. So in 6 months, you'd be up 40%. In a year, you'd be up about 100% based on these numbers. So you moving that position size, it changes the result. Now, so with those numbers, now that same 334 trades that was going to get you the 40% return will now get you a 100% return. So you see, the more turnover now is going to get you more return because now you've got that edge. That edge is larger. So how much is too much risk? Well, again, 1.25%, maybe 1.5% is the optimal number. This is what you want to shoot for, which again, at $100,000 portfolio, that means $1,250. So how does this work? Well, you're going to take your position size and you're going to times it by your stop, and that's going to give you what we call your return of total. Your risk of total equity. So now you have a 12.5% position. You take a 10% stop, that's 1.25%, right? If you had a 25% position and you took that same 10% stop, you'd be at 2.5%. That's the upper limits, and that's where you got to be careful unless you're really good at this. So to get to that 1.25, you would have to take a 5% stop, right? You doubled your position size, so you would have to cut your stop in half to get that same $1,250. Move it up to 50%, and now to get that same 1.25% risk of total equity, that same $1,250, you'd have to move your stop now to 2.5%. So your position size and your stop, these are what are going to determine your return, your risk of total equity. So those are the sliders that you move, and you're going to arrive at that number. This is another thing. We have calculators that you can use on our app and also on the platform. I'm sure there's probably others out there. I'm sure there's calculators that you can find that you can figure this out, or you can just figure it out yourself. Pretty easy, quick calculation. But that's how I approach risk and position sizing. Very straightforward. Those are the guidelines. And then, of course, you're going to have to determine for yourself if you're very aggressive, then you're going to take bigger positions. You're going to ratchet up faster. Your progressive exposure might be quicker than someone who's more conservative. You might decide to only have 4 or 5 positions, where someone's more conservative, they'll have a little more diversification. The key is with position sizing is you don't want to have tons of positions, and you don't want to be so concentrated that you get torpedoed in one stock, it blows you up. There is a balance in there, and that balance is anywhere between 4 to 5 stocks to 8 to 12 stocks, and I would say on the upside, maybe 16 stocks max. So with everything that you've learned, this next little riddle, if you will, whatever you want to call it, really boils it all down to the point of all this. And this is a question that I always ask at the end of the risk management section. And as a trader, which is the better deal? A $1,000 guarantee or $1 million with a 1% chance of losing everything? So think about that for a minute. So the answer to this, and the operative word here, or the operative phrase, is as a trader. Okay. Do you remember I said we look at the scenario where one person closes their eyes, they run across the street, they make it to the other side. The other guy looks both ways carefully, goes into the street with light traffic, gets hit and gets killed. Now, what if we bet on these people, 100 times? Who's going to make it? What if the bet was an all or nothing bet on that one scenario? They only did it one time. And I bet everything on the guy who looked carefully, right? One position. That's the equivalent of having one position, making an all or nothing bet. So I bet everything on this guy, and that happened to be the one outlier where, boom, he got struck and I lost everything. So the answer to this is that if it's a one-time event, well, then the $1 million would be the right choice. But is trading a one-time event? Absolutely not. You're going to make lots and lots and lots of trades. It's going to distribute over the bell curve, right? Remember, we're circling right back to where we started. So all your trades are going to come over that bell curve, and it's the average gain versus the average loss and how many times you can roll that edge over. So you're going to go across the street a lot of times. And the guy who closes his eyes and plugs his ears is going to get struck and is not going to make it to the other side nearly as many times as the guy who looks carefully. And if you bet everything on just one scenario, on just one trip or one stock or one hand or one spin of the roulette wheel, well, then you can lose everything. And the moral of the story is you can never, ever take any risk that puts your operation in jeopardy, where you will either lose it all or you will suffer a setback so big that you either can't recover or it takes so long to recover that it impedes your performance. That's what this is all about. It's all about mitigating the risk and making sure that you never get yourself into a situation where you get hurt, where you get set back so much or so violently that you're digging out of that hole and it's so hard to come back. It's bad for your confidence. It's bad for your portfolio, and you'll never perform. You'll never perform until you get this and you understand this and you approach every trade risk first. I assure you that at some point risk will get you, and you will never have a great performance. You'll never be more than lucky, because you won't have a methodology or a method for dealing with risk, and the risk is at some point is always going to rear its head, and losses work geometrically against you, and you'll be giving back. Just think about this. One last thing. You buy, everybody says, if you held Amazon, it's up, 100,000%. Yeah. Think about this. You buy Amazon, right? You hold it for 20 years. It goes up 100,000%. And then it tops and you go through a bear market. If it goes down 50%, you say, well, I only lost 50%. Yes, you lost 50% of 100,000. You gave back 50,000%. If it goes down 70, 80%, which the odds say that at some point a secular bull market leader, when it tops, will go down between 50 and 80%. The average is actually 70%. 72% is the average decline of a previous leader. So at 70%, think about what you give up. You see, so it's, again, you have to think that losses work geometrically against you, and everything should be based on risk. All right, when we come back, we're going to recap a bit. We're going to go over post-analysis. David will be back, and we'll go over that. And then I have a section. It's called Mind-Blowing Math. You're going to love this. If you enjoyed the risk management, you're going to really love Mind-Blowing Math. It's how we close everything out, and it's really quite amazing and empowering. So we're going to take a break. This was a long session here, and I'm sure you're filled up with a lot of things in your head, and it's time to take a break here. So we'll see you when we come back.